Imagine finishing dinner, setting down your fork, and knowing you just made 50 bucks. Or waking up in the morning to find $100 deposited into your account while you were sleeping. Most of us are taught a very specific set of rules about making a living. You show up, you trade your hours for a paycheck, and you go home. The problem is, the second you stop working, whether you want a vacation or you happen to get sick, the money immediately stops flowing. To get there, we look at things through the lens of money machines, or assets. An asset is simply something you own that puts money in your pocket, 24 hours a day, without needing you to physically be there. A consumer looks at their paycheck and thinks about what they can buy, things that slowly lose value over time. A producer looks at that same paycheck and thinks about what they can build or acquire to generate continuous value for others. Unless you find a way to separate the money you make from the hours you spend, you will always have a ceiling on your income. True financial freedom happens when you break that link entirely. The very first step to building your own money machines has nothing to do with investing. It starts with creating a gap. You have to spend less than you earn, leaving a margin of extra cash at the end of every month. This sounds simple, but our brains are actually wired to resist it. Psychologists call this psychological barrier loss aversion. When you take part of your paycheck and lock it away in savings, your brain registers it as a painful loss of access to your own hard-earned cash. Viewing that saved money as raw material helps lower the resistance. You're converting current cash into the gears, bolts, and wiring needed to assemble future money machines. Every dollar set aside is a part purchased for your own freedom. The biggest threat to building those machines is lifestyle creep. When people get a raise, they buy a slightly nicer car or rent a slightly bigger apartment. Their spending grows at the exact same pace as their income, and that crucial gap disappears. A person making $300,000 a year who spends $300,000 a year is building exactly zero wealth. Wealth is only created in the margin between what you bring in and what you consume. Once you have that gap, you need to buy machines. The oldest one is real estate. Mark Twain famously advised people to buy land, simply because they aren't making it anymore. Property offers two major benefits. Renters pay you a steady stream of income every month, and the physical building itself generally becomes more valuable over the decades. This chart shows the total value of global real estate compared to other major investments. That massive blue block on the left is residential and commercial property. It dwarfs global debt, the entire stock market, and even the total economic output of the entire world. If buying a house feels out of reach, you can build a stock swarm instead. By buying into an index fund, like the S&P 500, you are purchasing tiny, working pieces of the 500 most successful companies in the country. They do the work, and you get a share of their profits. You can make this swarm even more powerful by putting these investments inside special legal containers, like a Roth IRA. The government created these accounts to encourage saving. When your stocks grow inside this container, you are shielded from paying taxes on those gains, letting your money multiply faster. A third machine is the digital ghost. This involves creating an online business, like a course, a blog, or a video channel. Unlike a physical store, digital products scale effortlessly. You create the product once, and you can sell it to 10 people or 10,000 people with almost zero extra effort. Whether you choose a physical property, a slice of the stock market, or a scalable digital product, the objective remains the same. You are accumulating assets that operate independently, pouring steady cash flow back to you. This graph shows a typical investment timeline. Initially, it requires immense patience. For years, wealth barely grows. The line stays frustratingly flat. But wait, and compounding takes over. Interest earns interest. Given enough time, the curve bends sharply upward, building your fortune. To survive long enough to see that upward curve, you have to follow a strict order of operations. Before you buy a single stock or piece of real estate, you must build an emergency cash reserve. This protects you from having to sell your new assets if your car breaks down or you lose your job. Next, you have to eliminate the drag of high-interest debt. If a credit card is charging you 20% interest, it is effectively erasing the gains you might make in the stock market. Paying that off is your first priority. Finally, ignore the urge to chase the newest, hottest investing trends. The people who build lasting wealth are not the ones looking for a single lucky win. They are the ones who consistently repeat the process of saving and investing, month after month, for a decade or more. Ultimately, wealth is the cumulative result of these habits. By widening the gap in more income and funneling that margin into assets that produce their own cash, you allow time and compounding to build the fortune you set out to create.